Okay, let's move on to the balance sheet. The balance sheet, we covered a little bit under managerial accounting. We're going to cover it a little bit here. Combined, they should give you a pretty good overview of what the balance sheet's involved with. We know a balance sheet is an accountant snapshot of the accounting value at a specific point in time. It has a date on it. It is exactly what's on the balance sheet as of this day, a specific day. At the end of that day, this is the value of the assets and liabilities and equity of the company. Obviously, the balance sheet identity is assets equal liabilities plus shareholder equity. We talked about this previously, as we have borrowed money in the form of liabilities, and we have put our own money into the form of equity. What did we do with that money? We have bought assets. And so one side is the assets we bought with the money, and the other side is whether we borrowed it or we put the money in ourselves. The two have to balance, which is why they call it a balance sheet, of course. There's a few notes here. The first one is the assets exactly equal liabilities plus equity to the penny. So if you have liabilities that are outstanding, we will know what that number is. That's a given. You add up all your assets. That is the given. And what's left over, or the plug variable, the variable that is the one that goes up and down, of course, that is variable, is equity. Because the liabilities are given, the assets are given that are hard assets, you can measure those, and what's left over is the equity, or the value that the shareholders still hold in the company. And equity can be negative. You can have negative equity in a company. It's not a great idea, and it certainly shouldn't be too long, but much like you can be underwater in a house, you can be underwater in equity as long as you continue to pay your bills with cash, which is another reason why cash is king. Assets are also listed in order of liquidity, the amount of time it would take to convert them into cash in an operating business. So order of liquidity, obviously cash is the most liquid, and then you've got other things, accounts receivable, which is cash coming in, and then inventories, we'd sell off inventories, and finally at last, at the bottom, you get plant, property, equipment, which of course we could always sell, but it's just harder to sell. So liquid order is for assets. Accounts or liabilities, are in order and listed which they come due. So current liabilities, the sooner they come due at the top, all the way down to long-term debt, which is not actually due and payable for, it could be 30 years, it could be quite a while. So we think of assets, and we think of liquidity, and liabilities, we think of when do we owe them, how soon do we owe them. Current liabilities is short-term, obviously long-term debt is long-term. So we look at this balance sheet here. This is just a common balance sheet. It's the one that I think is still in your book, or pretty close to the one in your book. And you can see that we've broken it into different sections. They're shaded differently so you can see them. Current assets is cash, accounts receivable, inventory. Fixed assets are the plant, property, and equipment. Then minus the accumulated depreciation is net plant, property, and equipment. Then we have some intangible assets. We have some intangible assets that we have bought or created over time. And then we have total fixed assets. Total fixed assets, total current assets equal total assets. Liabilities, we have current liabilities, accounts payable usually, and then maybe some other things, short-term liabilities. And then long-term liabilities is deferred taxes. Of course, we've got to pay our taxes eventually, and long-term debt. So long-term debt would be definitely a long-term liability. And shareholders' equity. So we in this case, they've shown preferred stock. That's not always the case. We have common stock, and then capital surplus is how much money we've got left over. And then we have accumulated retained earnings and treasury stock, if we've left some stock into the treasury. And then we have total equity. So, and you can see that there's 2 years here, 2013 and 2014. So this is a tad bit dated from where you're probably watching it now. But you can see it completely balances. It's 1879 in 2014, and it's 1742 in 2013. It absolutely has to balance. You can see that there are different categories under each one, so you would be doing analysis under each one separately. But this is a common balance sheet. Now, to think of balance sheet analysis, one of the things we have to do is to break it into pieces so it's easier to understand. So the first thing we're going to look at that are of our three main concerns here are accounting liquidity, is can we pay our bills? The second thing is how much leverage we have. debt versus equity. Do we have a lot of leverage? If we have a lot of leverage, we are very risky. If we don't have a lot of leverage, we are not very risky. And then finally is the value versus cost. Value versus cost gets at the fact that we may have depreciated things down. For example, a building, we have depreciated down. We could depreciate it all the way down to zero. Well, the building isn't worth zero. I could sell it for something. So we've depreciated. The value of the building versus the cost that's included on the balance sheet might be tremendously different. So we look at these individually. Accounting liquidity refers to the ease and quickness that we can turn it into cash. Some fixed assets are intangible. So intangible would be, say, a patent. A patent is an asset that we might have purchased, which is an asset we paid for, but it's intangible. We don't actually go into a patent and hold it like a building or anything else. So we might have bought patents, say a drug company bought some patents off someone else. That is an intangible asset. And it shows on our books as an asset we own because we have the patent rights to whatever drug this is to produce. But it's not really a fixed asset. It's a long-term asset, but it's not fixed. So the more liquid a firm's assets, the less likely it is to experience problems. We know that cash is king and we can't pay our bills without cash. Liquid assets also frequently have lower rates of return than fixed assets. So one of the things that you're going to look at is how much cash and liquid assets do we have, and do we have too much? Do we have too much cash? Currently, when I'm taping this, Apple has a unbelievable amount of cash. It's tens of billions of dollars in cash, and they're just hoarding this cash. I mean, they have literally unbelievable amounts of cash, and you have to wonder as a shareholder, like, why do you have all that cash? You're not making any money on it. I mean, they've got it in investment accounts, but they're not investing into something that's risky. They're investing into basically treasury bonds or something that's extremely safe and extremely short term. So they're earning almost no interest on this cash. So they have hundreds of billions of, well, I wouldn't say hundreds of billions, but they have at least tens of billions of dollars of cash that's earning them no interest, earning the shareholders no interest. And so this is a concern. You don't want too much cash because you're not earning enough money on it. But on the other hand, if you don't have enough cash, if you don't have that cushion that everyone wants to see, you're becoming a little risky. Obviously, no risk with if you have $100 billion in cash in the bank, the risks are really quite low. Going beyond that, we look at debt versus equity. Debt versus equity is a version of leverage or a version of risk. Creditors generally seem for the first claim on cash from the shareholder if there were a problem. Shareholders' equity is usually what's left over. So when you think about a bankruptcy situation, is they pay the bondholders first, and then whatever's left over, if anything, they pay the shareholders. But if the bondholders don't get 100% of the money, shareholders get nothing. So you are taking the risk. You are investing in the company. Now, because you're taking the risk, you get all the profits. The bondholders don't typically get any of the profits. So when you think of a situation where which side would you want to be on, well, the bondholders are more secure that they will get their money back plus some profit. But if there's big profits, the equity side or the shareholders will benefit from that. The bondholders only get whatever the coupon is on their bond. The last one is value versus cost. Under GAAP, financial statements are carried at their historical cost. The market value is the price at which assets and liabilities and equity could actually be bought or sold. And the company, which is completely different than the historical costs. So we all know that if you've got a home, if you've been familiar with homes, you know that there's a value on your property taxes of your assessed value of your home. Well, you would never sell your home for your assessed value. That your home's almost always worth way more than your assessed value. So when you think of the type of difference here that you're going to see, is the value in the market could be dramatically different than the value that is carried on your books. And therefore, if we're going to do financial analysis, we have to adjust to today's market costs. Failure to do so would give you a erroneous price in the marketplace, and that would be very detrimental to making good decisions. So we've covered three areas here. The three areas are accounting liquidity, debt versus equity, and value versus cost. So when we start to analyze our balance sheets, we want to be thinking about these things and how they impact the firm and where the firm is with regard to each one.